Welcome everybody to Cowboy Metals Live. This is your host, 𝙎𝙁𝙏𝙼𝙍, 𝙂𝙊𝙏𝙼𝙍. It is Tuesday, April 5th, 2022. Welcome to the program. We're going to let everybody load in and join the chat before we get too far into it. Hope everybody is having a great day and had a great weekend. Looks like sound is working on the sound check. Welcome everybody to the stream. This is Cowboy Metals Live. I'm your host, 𝙎𝙁𝙏𝙼𝙍, where we broadcast from the great state of Texas and we take no bullshit. We're gonna have a lot of good guests in here today, and a lot of people have been waiting for this. I've been traveling a bit, so I didn't do a live stream last week, so we're gonna make up for it today. I've got a really good presentation for you guys. Welcome everybody to the program. Joseph S. is here. Tom Jode is here. Ralph Potts, as always, is joining us. Thank you, Ralph, for dropping by. 12 Zeros is here. Jonathan is here. Fantana Ranch is here, of course, always joins us on the live streams. Thank you, everybody, for joining. Hey, Ralph, how are you? I heard the news in the chat that Rob Kirby had died. I've not been able to verify that. I haven't heard anything. Certainly, Rob was on our program a bunch of times in the past. Somebody I have a great respect for. So if that is the case, then prayers be with his family, because he was quite the gentleman and quite the knowledgeable person, and quite the freedom fighter as well. And I have a lot of respect for Mr. Kirby. So prayers for his family. And my hat is off to Rob, who fought the good battle while he was alive and was a big influence on a lot of us. So thank you so much for that. My hat is okay. Do another sound check. Looks like we're good. Privateer is here. Thank you, everybody, for joining in. We got about 50 people. We'll get started here shortly. As a reminder, we have a poll up. The poll is, do you fear the new system? And by the new system, that's what I'm going to be discussing today. It's the new central bank digital system, the end of the fiat currency era, and how gold is going to play into that. That's a presentation I gave this morning at a conference, which I'll show you that here in just a minute. 29% say yes, 32%, about a third, say no, but I'm prepared, not worried about it. About 38% are saying yes, but I'll make it through. And nobody, of course, is saying the banks will save us. That's, of course, because you guys are the smartest guys, the smartest audience, and we know the banks never save us. Go ahead and vote in that poll, guys. Do you fear the new system? And we'll read out the results as the live stream goes through. I am fresh back from Puerto Rico in Reno. Gonna be out in Miami for just a day later this week to do a private event for tech influencers, which I've been invited to. Very much ecstatic to be doing that, but since it's a private event, I can't advertise it. Sorry, guys. Joseph S. asks, how much longer do we have until SHTF? I don't know from a day perspective. I would tell you from a milestone perspective, we're really close. I always say the 11th hour, somewhere between 11 p.m. and 11:59 p.m. Although it's entirely impossible to tell exactly. We just have to look at the milestones, and that's what I'm going to be talking about today. So stay tuned to that presentation. All right, we've got 81 people in, so we're going to go ahead and jump right into it, guys. First thing I'm going to talk about is the lecture that I gave this morning. Let me get over to that. I was on this morning at the Money, Metals, and Mining Virtual Expo at about 10:40 a.m. Eastern Time, 9:40 a.m. my time, Central. A lot of you guys did show up and ask questions. I appreciate you doing that. It always is great when I go to a speaking event, you guys are there to do the Q&A piece after the presentation. It was called Gold, Why This Time is Different, and that's exactly what I'm going to be sharing with you guys again today. Now, this is something that I've talked about on the program in pieces. I'm going to kind of put the whole thing together for you. I also discussed probably about 3/4 of this for our Patreon audience back when we had Patreon, but we'll be updating the rest of you on it as well. And well, I've added new stuff. So I gave it at the OTC conference last year, and I've added some new slides and updated some of the data in here. So I think you guys, it'd be a good time to go back over it, given all the changes we see in the world. Of course, we've talked about de-dollarization and the new system and what it means. Welcome 100% Canadian for joining the live stream. Christopher Power Thorse is here. What a name. 𝙎𝙁𝙇𝙿 is here. Much of the research posted by the Federal Reserve has implementation occurring 2023-2024, says 𝙎𝙁𝙇𝙿. That could be the case. So look out for those dates. Sarge is in the house. Thank you, Sarge, for joining us. Thank you, everybody, for riding shotgun. Remember to vote in the poll. And we're going to jump right into it. It's been a couple of minutes, so we've got about 100 people in. We're going to do the presentation, and it's going to be gold. Why this time is different. And here is the presentation, ladies and gentlemen. I'm just going to put it in slide mode. Actually, let's see if it'll do presentation mode. Last time I tried to do this with Zoom, it wouldn't. but we're going to see if it does on the program. Let's let this live stream update. Here we go. We got it. All right. So we're going to go back to the presentation. Gold and silver, while this time is different. We're going to jump right into it. A lot of you guys have heard me talk about the S&P, which is our stock market, S&P 500, and the price to earnings ratios. Now I'll explain a little bit about what I'm talking about here for those of you who aren't really stock guys or have a lot of experience in stocks. A price to earnings ratio is the price that you pay for a share of stock compared to what that share has earned, or the earnings per share. So let's say you're paying $10 for a stock and it's earned $1, you're paying 10 times what that stock would have earned the company in that period of time. It's simply just a measure of how much you're paying for the earnings of that company. Of course, you want positive earning companies so that they don't go bankrupt and you don't lose your share value. Well, let's say you're paying $100 for a share of stock and it only makes $1, right? You're paying 100 times earning. That means you're probably overpaying. And so price to earnings ratios are a way that we can check overvaluation of the stock market over time. Are we overvalued or are we undervalued? Well, how do we know exactly? Well, a bunch of guys got together, and I'll tell you who those guys are here in a moment. But they got together and put together something called the PE10. The PE10 is price to earnings ratio over a 10-year period, and it's rolling. It's constantly updating over 10 years. It's also known as the CAPE, the CAPE, or the cyclically adjusted price to earnings ratio. So unlike just a regular price to earnings ratio at a particular point in time, it is a rolling 10-year average. And what it does is allow you to compare periods to know where you are when compared with previous economic periods. So you can see here on the left-hand side, if you just look at a straight price to earnings ratio, not the PE10, not a rolling, then last year we got really high. We're at 190.98 in December. I don't know what they are right now. I couldn't find a chart for it, but they're really, really high. The price that you pay for a share of stock compared to what it's earned is really high overall in the S&P 500. Well, if you take the PE10, the chart on the right tells you where we are when compared with history. Now, this red line running bottom left to upper right is the mean, or the regression line. It's the average over a long length of time. And when you're at the average, you're at what will be called a fairly valued stock market. And if you're in a blue line below that, it means you're in a bargain stock market. If you're a line above that, you're at an overpriced stock market when compared with the mean over time. This is the value of the PE10 or the CAPE specifically, rather than at a point in time, you can compare previous periods. Now you'll notice 1929, right before we had the stock crash, we were overvalued. We were over the mean line. Same thing with 1901, same thing 1966, the tech crash in 2000, and in 2007, 2008. But if you'll notice right now, we're more overvalued over that mean line. In other words, this space is bigger between where we are from a price to earning in the S&P 500 and where the average is, which is this red line. We have a bigger space here. So they're more overvalued than at any time since this has been kept dating back to 1870, which is about 152 years. So we're at the highest valuation of the stock market, overvaluation, meaning we're paying more for shares of stock in the S&P 500 than we should, relatively speaking, dating back 150 years. Pretty darn big amount of overvaluation. And what does that mean? We're going to get into that. We're going to look at it from an historical standard deviation. So if you guys remember back to math, statistics specifically, and we talk standard deviations, you have a mean, you have a line right down the middle, and on either side, you have this bell curve, typically some sort of curve. It can be a perfectly shaped bell or something else. And then one standard deviation on either side is what's considered the bulk of the data. Most of the data will fall within one standard deviation either side of the mean. Once you get further away from the mean, more standard deviations away, you get into what's called an extreme value. So now if we look at price to earnings ratios from a standard deviation, you can see that right here, this red 161% on the far upper right of the chart means that we are the most overvalued from the mean in history from a standard deviation perspective, or a statistical perspective. More than the crash 29 before the Great Depression, more than the tech crisis of 2000, more than the mortgage crisis in 2007, 2008, more than at any time in history dating back to 1870. The stock market is more overvalued relative to any other previous period. That's the value of the PE10 or the CAPE. It tells you that we have put way too much value in stocks. Why does that matter? Well, let's talk about the PE10. What does it mean? It was developed by Benjamin Graham, David Dodd, and Robert Shiller. They popularized it, three very smart gentlemen. The PE10, also known as the CAPE, is just shown as a calculation of the PE ratio over a 10-year rolling average to reduce the distortion of temporary swings in the business cycle and to allow for longer-term comparisons of stock valuations over time. When the CAPE falls from the highest to the second quintile, it is always bottom to the lowest quintile, and typically single digits, meaning when you get as high as it is now, it comes all the way down back through the mean, all the way going to negatively undervalued is what that means. Translated, we have, and I think we are in the last market melt up, and then it all comes crashing spectacularly down just like it has done in previous times in history. Why is that important if you're a gold and silver investor? Well, ladies and gentlemen, when the stock market crashes, what goes up? First gold, and then right after silver. Now I'm going to stop the presentation now to see if you guys have any questions and make sure we run a sound check and everything's good. Sound check is good, everyone. We're about a third of the way through the presentation. Everybody understand PE10, CAPE, overvaluation of the stock market. Any questions there, please ask me in the stream. I'm happy to answer it. And as Sarge says, yet, despite all the overvaluation in stocks, we only pay $9 over spot for silver. That's exactly correct. And even though it has a premium, it's still relatively undervalued over time. Silver is. 𝙎𝙊𝙇𝘿 says, Rob, what do you think about the commodities, wheat, liquid natural gas, LNG, etc., being cut off to Europe from Russia? If the Eurozone is unable to supply itself domestically, can the US be able to supply new demand? No, because we're in a point in time in which it's all just-in-time production, all just-in-time inventory. So if you take any chunk of world production away through sanctions and through trade embargoes, that means that the rest of the world has to make up for it. And it's not there because we don't produce a lot more than we need. At least the markets tend not to do that. So everything's going to go up in price. That's what that means generally. Steve Ross Holmes, thank you for the contribution with the super chat. And as a reminder, super chats are open. If you do those, I can guarantee to answer your question or answer your comment because I'm guaranteed to see it. He says, if Russia, China backs with gold, wouldn't that force us to compete and therefore we would need more gold? If we don't have enough, what options will we have other than confiscate from evil hoarders? Long answer to that question. I'm going to shorten it and say yes. Since, and you're kind of stealing my thunder just a little bit, it's okay, no big deal. Russia has backed the ruble with gold. And so what happens is it puts a floor on the gold price, at least in terms of rubles, and it forces people to accept rubles and give away gold. So that means Russia can accumulate more gold. It also puts pressure on the Western derivative markets to potentially revalue gold on those, and more on that later. But yes, if Russia and China were both to back it, Russia by itself is not a big enough economy to force everybody's hand to back it with gold or show their gold, show their hand, so to speak. Like you would in a game of poker and show how much gold that you have. So Russia by itself, no. China, yes. And we'll get more into that later on. Remember the poll. Do you fear the new system? Right now, about a quarter are saying yes, 41% saying no, I'm prepared, 31% yes, but I'll make it through, and 2% saying the banks will save us. Oh my goodness. All right, getting back to the presentation. Here we go. And let's see, actually, if we can get this back in the presentation mode. There we go. So moving on, but what is different now? Why is it different? Why is this presentation called Gold this time is different? Well, the Fed has implemented the biggest money printing program of all time in terms of US dollars, creating 40% of all M1 money supply in 1 year in 2020. The US government has never been in higher debt or had higher yearly deficits. The corporate sector is the most indebted it has ever been. And this includes 180 billion in negative interest yielding debt as of last year. The reason those are negative yielding is because corporates had to force, they couldn't afford debt service or interest payments. So they had to force the people that are buying their bonds to pay them to issue the bond. Because if they had issued a positive interest rate, nobody would have bought it and they would have defaulted on that issuance. And probably defaulted on their debt payments because they're issuing more debt to pay for old debt. We'll get into that here in a moment. The consumer has never been more indebted than at any time in history, suggesting a consumer-led recovery is not possible in the near future. And the Fed has no bullets in its gun unless the system changes substantially. What do I mean by that? They don't have the 5 to 6 percentage points of positive interest rates that they need to fight a recession. In fact, right now they want to raise rates 7 times this year, once immediately and then 6 more times to get interest rates around 2%, but 2% is not enough room for when the next recession comes. And I would argue that if they raise interest rates, they're going to cause the next recession. So they cannot stay on the positive side of interest rates and fight a recession. They got to go negative. That, ladies and gentlemen, is what is different. But let's talk about debt. Look at debt to GDP. Right now, it's 140 times debt to GDP. According to Kenneth Rogoff in his famous book, he basically pointed out that when you get to 90% of debt to GDP, you're at the point of no return where there has to be a debt restructuring or a financial restructuring. We're at 140. So we're basically hopeless in terms of the debt system has to reset. But I'm going to argue it doesn't have to reset. It has to go away. We'll get to that in a moment. Looking at consumer debt, here's a nice chart from debt.org. The silent generation, or my parents' generation, the wartime generation, has a certain amount, and it looks pretty strong. It's a lot, 40,000 a person. Baby boomers, 96,000 a person, and they're retiring. And yet we think that they actually have money to retire, but they actually have $96,000 of debt per person. Gen Xers have $135,000 in debt per person. My generation is the most indebted generation per person. The millennials are not far behind at 78,396 and Gen Z at 9,593. So what that means, if you turn this over like this, it's a bell curve, right? Those are at their prime spending ages, have taken on the most debt, and that's Gen X. But every generation has debt, and that's a problem. When you have that much debt per person, it's very, very hard to be solvent to deal with financial resets. So the debt must be addressed. It's endemic across all levels of our system. A debt devaluation or elimination must occur for the system to recover to normal levels and begin to heal for the next upward cycle. However, we're at the end of a super cycle, and that's what's different. So I'm going to bring together conjunctive wave theory. A lot of you have heard me talk about that before. And we're going to talk about Sir John Glubb's research on the rise and fall of nations. There's a good paper he wrote in 1971 about that. And he had traveled around the world, had been in the military around the world, and had been a public speaker, and was doing this research for the Crown, I believe, or at least the Crown used it after he did it. And it showed that every 80 years, we have a big reset, big financial reset. That's the conjunctive wave cycle. And it's 4 generations of people, about 20 years each. And they're basically seasons, if you divide it up, spring, summer, fall, winter. Winter is the worst part of course, when you go through all the turbulence, you reset the system, you go back to spring. Well, about 3 of those cycles, 3 of those 80-year cycles can occur in a 250-year cycle. And in that 250-year cycle, nation states rise and fall. So we're about 240, 5 years, 6 years since the Declaration of Independence and then the Revolutionary War. So the United States is right in that period of time in which it's going to come off of being the dominant nation state. Now, according to Sir John Glubb's research, he did this all the way back to the ancient Assyrians, almost 3,000 years of history. This is pretty static, according to Rome, Spain, the British, the Assyrians. All of the great nation states that he studied had about a 250-year cycle. Rome had 2, because Rome had the Republican cycle and then the empiric cycle. So he broke that into 2. It also had 2 civilizations, East and West, but about 250 years each. So you do 3 economic cycles equals a nation state cycle. And that 3rd cycle, the nation state system breaks down, new dominant nation state rises. And if I had to say who that was going to be, I'd probably say China. They're the 2nd largest economy and rising the fastest. They're probably going to be the one to replace the US on the world stage and in the major currency system. This is the origin of the concept of the Great Reset, which the WEF talks about, World Economic Forum talks about all the time. IMF and BIS are talking about it. Mainstream media is talking about it. It's a reimagining of the financial system that has reached a super cycle peak. So not just an 80-year cycle, but a 250-year cycle. And I would argue if you look at bond rates, which have been falling for 700 years across civilizations, it's also a 700-year cycle, almost a millennial cycle. The Western system needs a redesign, not just a reset. So because this is a really long cycle, it needs a complete reset. And therefore, the monetary system will have to change. Before we get into that, I'm going to stop the share and see if you guys have questions and do another sound check. Looks like our connection is good. We got positive sound. Hello, Prepper Days, for joining us. Mutant Ryef is here. Thank you, everybody, for joining the live stream. Edge Brand Agency. Looking for questions. Don't see any at the moment. Lots of comments. Thank you guys for commenting in the stream. So far, we have gotten through about half of the presentation on gold, why this time is different. Presentation I gave this morning at a conference at Money Metals and Mines. I gave it on the OTC last year, but I updated it and I wanted to reintroduce it out to you guys because we have a lot of new information I'm about to get into. If you have questions, super chats are open. You can do that and it shows up really bright on my screen. I'll make sure and answer that for you. And remember that we have a poll. Do you fear the new system? Right now, about a quarter are saying, yep. 40% are saying no because I'm prepared. About 30% say yes, but I'll make it through. And somebody is answering the banks will save us. I'm not so sure I'm confident in that, but it's okay. It's a good enough answer. All right, here we go. We're going back into the presentation, ladies and gentlemen. We're going to finish it up this time through. Here we go. You ready? We're going to finish it. All right, into presentation mode. All right, the current stock market meltdown. I'm going to explain why the stock market's melting up. It's called the wealth effect. This chart was put together by my good friend 𝙂𝙊𝙇𝙑𝙀𝙍, who is producer of The Money Game, which, by the way, is about 30% filmed. And we sponsor it. I'll talk about that later. Anyway, he put together this chart, and it shows as interest rates fall, asset prices rises. So for every 10%, rises $10, 5%, $20, 1%, 100. Why? Because the formula is $1 over the interest rate. So the lower the interest rate, the more the asset value goes up, to the point at which you get into negative interest rates, asset values can go to infinity. That explains why the stock market P/E ratios are so high. If we look back at this chart, we're very high. Why? Because we're basically negative real interest rates on debt. If you consider inflation and the interest rates, you take the interest rate at 2 point something minus inflation at 7 point something, you got negative real interest rates. But it'll go even higher if we get real nominal rates, which is just the printed negative interest rate. So when interest rates go negative, all assets are worth infinite. Why? That's the way the computers treat it. It's a math problem. They look at the math and say, oh, you can go up forever. But the computer algorithms don't understand natural law and natural economics, which we'll get into. So what about negative interest rate debt? The rise of negative interest rate debt, that's debt which has a negative interest rate, which means you buy the debt that somebody else has to pay you, but you pay someone a rate of return to let you buy their debt. I mean, guaranteeing you losing money. Why anybody does this, I don't know, but that's what the system needs to keep going because there's so much debt in the system. There's not enough currency and not enough production to pay all of that debt service. But the effect is it's removed risk management from the financial profession. There aren't enough risk managers anymore employed in the financial system. They've all moved on to other roles, and it's the computers doing this, and the computers have a broken mathematical model. That's created a moral hazard where sovereign and corporate debt markets get incentivized to take on debt and have no penalties for misallocating capital to non-productive endeavors. That's why you can have companies that earn no money but have really high valuations. And this has led to the rise of zombie companies and poor spending by governments on social programs. And the typical warning indicators of the economic dashboard are being ignored by the computer programs and algorithms. So according to the BIS, we have the highest number as a percentage of zombie companies on the rise. What's a zombie company? A zombie company is where they can't service their debt or they don't make money and they're not expected to live. They're walking zombies, a la The Walking Dead. You kind of have to shoot them in the head with a gun to put them out of their misery. Not only do we have the highest amount of zombie companies, and this is, by the way, across the world, not just in the US, but the confidence factor for them ever getting out of being a zombie company and becoming productive is at the lowest ever. There's about a 90% chance that all these companies are never going to recover according to BIS. If you look at the red line is the confidence indicator on recovery. The blue line is the amount in percent of zombie companies. So this is bad. The BIS here is basically predicting a massive default of corporations across the world, not just the US. Why? Because of debt. And at the same time, that debt is destroying our current currency system and economic system. De-dollarization is amping up. Just in the last couple of weeks, we've had China strike a deal with Saudi Arabia to deal oil for yuan. That means no more dollar trade. Russia is requiring their natural gas to be paid for in rubles, and Russia pegged its ruble currency to gold at about the equivalent of $15 or $50 US, give or take. What does this do? It's the end of the petrodollar system. The petrodollar system matters because everybody had to trade for oil in dollars, which meant they kept their own reserves of dollars. That rose demand for dollars, making the dollar strong compared to other currencies. And these Eurodollar accounts, as they're called, are now going to be dumped on the market as people now trade for yuan, trade for oil in yuan and other things. Russia requiring gas to be paid for in rubles supports the Russian ruble. It increases demand, makes the Russian ruble more valuable compared to other currencies, and requires everybody to now hold Russian rubles if they want to buy gas from Russia. And guess what? Russia has a whole lot of natural gas. You know, something like 20% of world production. It's a big amount. And Russia pegging its ruble currency to gold is basically saying, screw you, US, end of the petrodollar. We're going to peg it to gold. And what that's going to do is cause people to take rubles and give gold, and it's going to push more gold into Russia at a time in which it needs it. All right, now on to cashless and CBDC. We're going to wrap up the presentation here soon. I'm putting together all these various dots for you in like a star map or a star constellation so that you can understand what's going on. Published in 2015, the IMF proposed getting rid of cash and moving to all electronic money. In this paper that they published, hypothesized the end of the current debt-based fiat system, and it proposed the use of electronic cash, where the aggregate or the total monetary flows in a society could be centrally managed by the government for the first time to control inflation and deflation cycles. Now, previously, they've been able to control money supply by 1, taxes, and 2, debt limits, debt ceiling limits. But if the debt system breaks, they need something to replace that secondary control, and they're going to do it through the banking system, through your bank account, and I'll show you that in a minute. Negative interest rates will be used in the banking system to control free cash and also the potential velocity of the money supply. Why? Because they don't want a hyperinflation. They don't want a loss of confidence in the digital currency that they're going to replace the paper money with or the fiat money with. So they need to be able to control both the velocity and the amount, the speed at which it's used and the amount that's out there to control that monetary supply. The Bank for International Settlements, the BIS, and 50 central banks have adopted this plan for the next monetary regime. So it's coming, whether you like it or not, to a major country near you, including the United States, China, UK, all of Europe, Australia, Southern American, wherever you want. Plans are underway to develop the technology implemented, which will occur in stages. Yes, that includes the blockchain and cryptocurrency technologies, although it's not decentralized like the private cryptos like Bitcoin and Ethereum. It's centralized and controlled by the government, and it's a closed-ended system, not an open-ended system. So they're using those ledger technologies and those distribution technologies to put electronic money in the system, but they're close-ending the system so that it's not truly decentralized or free. Ain't that great? So let's say you get $100, it goes into your bank account. They give you 95 electronic dollars. What does that do? They've implemented a negative interest rate of 5%. Let's say they give you $90 for every $100 you deposit. They've implemented negative 10% negative interest rates in the banking system. And you don't even have to buy the bond. They're not going to force you to buy the bond. They just take it right out of your account as soon as the money comes in. And why are they doing it through the banking system? Because the IMF paper said people will not adopt a new system. We have to use existing systems. So we're going to use existing banking system to implement negative interest rates to control aggregate money supply through the commercial banking system. Ain't it great? What does that mean for gold and silver? Gold, according to Basel III, is used as a central bank barometer in the new system and making price hedge physical, meaning they hedge the price fluctuations in the derivative markets like COMEX and London OTC and Shanghai and all that. It makes it equivalent to cash and bank stock as a high quality liquid asset in the banking system. Gold is now being held in strong hands and discouraged for individual use. That's why the central banks have been net buyers since 2011. Individuals will be expected to support the new central bank digital currency infrastructure, and SDRs will be the top level of the system for trading like central banks. What does all that mean? Top level banker money is SDRs, special drawing rights. Second level for the people is central bank digital currencies. That's a digital dollar, digital yuan, so on and so forth. Underpinning all of that is the amount of gold that they have, which is one of the main assets, including cash and bank stock and other things, would be used to value the strength of the bank system. So does Russia have stronger banks or does the US? Does China have stronger banks or does the ECB? Gold will play a big role in supporting that system, but they don't want you to have gold because they don't want you to have control, independence outside the system. And once they revalue gold and the reset, they really don't want you to have it because you'd be rich and you'd have economic power, and they don't want you to have economic power. That, ladies and gentlemen, is the end of their presentation. If you have questions about it, please throw them down in the super chat. I'm gonna do a real quick sound check. Yep, sound is working. Ralph Potts says, thank you for 2 great videos today. You are welcome, Ralph. Thank you for joining the Money, Metals, and Minds Summit this morning. I know a lot of you did and asked great questions. I always say I have the best audience in the world because you guys show up no matter where I go and you ask the best questions. And the host of the conference told me after our presentation, not only do we have a good presentation, not only did I do my job, you guys did your job and asked the smartest questions of the day. You guys get credit for asking the smartest questions of the day at that conference, a worldwide conference. Good job, guys. I appreciate you showing up and doing that. Bubble Ox is here. He says, Ethereum is not decentralized and is owned. Cardano is decentralized, is administered by vote. I agree. And Ethereum is going to proof of stake, which just means the wealthy are going to get wealthier because that's how much money you have determines who controls Ethereum. I'm not a big fan of Ethereum, but hey, it is what it is. 229 in the chat. Thank you everybody for joining us. I just went through gold, why this time is different. Hope you guys got a lot out of that presentation. Thank you, Steve Ross. I think I answered your question both immediately after you asked it and in the presentation. If you have any other aspects of that question you want to ask, feel free to do so. P2RP says, this is what scares me about a new system, a cashless digital monetary system. I agree with you. That's why you have gold and silver, because it's outside the system and allows you to trade value for value. Going back to the poll, 157 votes so far. Wow, most people have voted. Do you fear the new system? 29% say yes, 38% say no, I'm prepared. 30% say yes, but I will make it through because you've made some preparations and you've armed yourself with knowledge and commodity money. And 3% still say the banks will save us. I don't think the banks will save us, but hey, if you want to answer that, it's okay. All right, ladies and gentlemen, without further ado, we're going to launch our new service today. We're going to talk about it. So I've started a new website. In fact, I'm just going to show you that new website, ladies and gentlemen. If we get over to the page, as a reminder, this is where I spoke this morning. Thank you for those that joined me there at Money, Metals, and Mines this morning at 10:50 Eastern, 10:40 Eastern. We have a new website, ladies and gentlemen, not only talking gold and silver, but a lot of you may not know this. I actually started in real estate. I was a fully licensed broker in stocks and commodities for a period of time. I'm not anymore, not a financial advisor anymore. I want to make that disclaimer. Please contact your financial advisor before you listen to anything we say. But at one point in time, I was. And so I wanted to talk about those things. So instead of just talking about gold and silver, we started a new website called Financial IQ Television. The website is finiq.tv, real easy for you guys to remember. finiq.tv, Financial IQ Television. And we now have 3 domains of stuff that we're talking about. We have Gold Silver Pros. You see here, you click on this and it takes you to the Gold Silver Pros landing page where it has all of our content right here on FinIQ website. So you can get it here just like you can get it on YouTube. And guess what? We started the Real Estate Investor, where once a week we'll have a real estate podcast. And I've got a couple of podcasts for you in real estate already here. How building teams in real estate will lead to success, and how single family rentals are your path to financial freedom. And in addition, ladies and gentlemen, we have started a Stocks Weekly. Why have we started stocks? I just got through talking about how price to earnings ratios were so high. Why would you want to touch the stock market? Well, in any given market, there are value stocks. If you follow Benjamin Graham, if you follow Warren Buffett, if you follow Peter Lynch, you can find value in any market. I happen to think the commodity sector is the most undervalued in the market. And we talk about that in Stocks Weekly. But remember, when the financial system resets and your gold and silver is valued really highly, you may want to buy other assets. That's why we're going to talk about them. We want to build your knowledge of all these other assets as well on Financial IQ TV. Now, this is all free, by the way. Same model as we have for Gold Silver Pros. We're not charging anything for it. We will take some sponsors later on after we get this built up. So you can see us on YouTube. We have separate YouTube channels for Stocks Weekly, for the Real Estate Investor, and for Gold Silver Pros. You can also listen on Spotify and on podcasts. And right here, we have it for you. If you just click on this link, you'll go to each video. We have 2 videos in each category right now for stocks and for real estate. We're building that content up. So come here if you want that content. I'm going to preview some of that content. So let's make sure I'm sharing with sound. I believe I am. Yes, I am. So let's talk about some of that content. We're going to preview some of it for you. So this is an interview I have with my good friend, Jerry Becker, who runs a real estate, who is a real estate investor in North Texas like me. And I join his group every couple of weeks to sit down with him and talk real estate and listen to his experts. He also teaches. He runs real estate investing for newbies in Dallas-Fort Worth area. If you're interested in joining any of these meetings, let me know. I'll get you guys hooked up. But here's a little segment that we had with him from our podcast dealing with real estate.
Yeah, absolutely. Glad to. Hey, yeah, and around the end of the 1990s, Robert Kiyosaki wrote a book called Rich Dad Poor Dad, and he followed up with a book called Cash Flow Quadrant, which I highly recommend people read. And what I got from it was, how do you move from trading time for dollars over to passive income, right? And so it eventually frees you up, gives you time and freedom to do what you really want to do, or what you might be excited to do, passionate to do it for in life. So that was the key basis for why we started the club. So then I actually have a real estate license as well, and I got that in 2001, and then 9/11 hit. I really didn't do much until probably about 2005. And then came across a group called Nouveau Riche around 2006 or 7. And got into real estate investing. We were, as agents, we were actually doing short sales back then as the market was changing and so forth. And so we were adapting.
So Jerry goes on to talk about all of his different strategies in real estate. This is a great podcast to watch. If you're considering real estate as an investment, I fully recommend it. It's the first thing I got invested in 2000, way before I invested in anything else. It offered me a lot of financial freedom. One of the reasons why I don't work a full-time job anymore is because I have some of these passive investments. So go watch that episode. There's also another episode that's coming up this Friday. 𝙂𝙊𝙊𝙎, our channel moderator for Gold Silver Pros, also happens to be a real estate investor out in California, and we talked to him about his story. Stay tuned to that this coming Friday. Remember, we do a podcast once a week on real estate and in stocks. I wanted to talk about another podcast we had on Stocks Weekly on FinIQ TV. This is my good friend Logan Kane from Seeking Alpha, is one of the sharpest young investors in the market. He's a contrarian investor in the stock market. And here we have a clip about him talking about his approach to the market.
Yeah, so I have a lot of contrarian views on things that people have found sort of interesting. My main deal is to trade against biases and constraints of people. So there's a lot going on in the economy right now. There's a lot of, there's money printing, there's the valuation issue, there's the Fed. So I just try to help people make sense of everything. Really, the goal is to make money after tax, after inflation, and be able to maintain a good standard of living. It's really the holy grail of investing. So that's what it's all about.
So Logan, again, is one of the smartest guys I know. He actually happens to be here in the Dallas-Fort Worth area. We sat down and had lunch. We've been writing together on Seeking Alpha for a long time before I quit. Super smart guy. You can find him on Seeking Alpha. You can find him on our channel. Go watch that video. I have another video on Stocks Weekly from Peter Chang, who's an angel investor and a real estate investor up in the New York area, has 2 offices there. And we're talking about his approach to the market and kind of how he got started. Here's a little excerpt from that interview. So you mentioned positioning. It's one of the most important things for an investor to know. And there's lots of investments out there. So how do you figure out how you want to position yourself?
That's a good question, Rob. How I started investing was I like to invest in fundamental plays, like invest in a company that pays a dividends and reinvest every quarter. So which was great the last decade since the crisis, the '07 crisis. But what I notice now that since the government's been printing so much money and we have so much debt as Americans, it's we don't know when that's going to end, and it's causing a lot of inflation. What's the marketplace and.
So Peter goes on to talk about some stocks he likes. On the Stocks Weekly, I asked him to pick stocks that they like. So Peter's all in on commodities, literally all in. Logan is investing some other areas of the market he thinks has value. They also give stock picks during these. So if you want their stock picks, if you want to know how they're investing in stocks and doing it in a value way that protect wealth, they're there. If you want to know more in real estate, go listen to Jerry, and then to the upcoming one that we're going to have with our channel moderator, 𝙂𝙊𝙊𝙎, coming up this Friday. That will be posted on Financial IQ television. That is the debut of our new service because we know more than gold and silver. Now we're going to be adding more. We're going to be adding a fintech channel here in the next week where we talk about financial technology. We talk about DeFi and all that kind of stuff. We'll be adding more as we go along in personal finance, wealth management, risk management, and other things like that you need to balance your portfolio, because at the end of the day, you're going to invest in more than gold and silver. And we have experience in that, and we can bring you what I don't have experience in. I'll bring on experts on the show to tell you. That's Financial IQ TV, finiq.tv, all free for you. Always will be free. It's the anti-CNBC, no propaganda, no garbage, just straight up actionable information in each of these markets from experts. All right, Dissident Agnostic, thank you for the contribution. Ask the question, do you think our cash in the bank will be deleted? I don't think deleted as in the zeros will be taking off of your bank account. I think they'll discount it for negative interest rates, but I think they're going to get rid of regular cash. Now, the IMF paper that they referred to earlier in the presentation did mention that it takes about a generation for people to accept the new system. So this is going to be a transition into the new system. It's not going to be, they're not going to hit a switch and turn it on and off, but they've already kind of got us there. They've already got us using credit cards and things like that. And as the baby boomers begin to retire and lose some of the political power, they're going to force in more of the digital currency system. And that's coming, and that's the way they're going to do it. And they realize this, and they realize that certain European countries, the US and certain other South American countries like cash, and they don't like digital currencies, or they don't like electronic like credit cards. And so in certain nation states, it's going to take a little longer, but that's the plan worldwide for them to roll out. Good question. Thank you. Thank you, everybody, for joining. The real mongoose is here. How could we do it without you, the real mongoose? Micah Riggs is here. Thank you for all the comments. That's all the questions I see as I scroll through the chat. This has been gold. Why this time's different? Oh, I got one other thing to share with you guys. Now we're doing something special. And this really is for you guys. It is the fact that we have gotten down to a single, and I mean a single precious metals dealer on the website. Now, I used to bring you multiple ones. We've settled on the one that we trust the most, that we feel brings you the best value, and we've gotten rid of everybody else. So this may surprise some people, but I'm doing this because I want the best for you guys. I will only work with high integrity people, and I will only work with people that I feel give the best value on precious metals deals. So if you click on that precious metals link on our website, Gold Silver Pros, you get to the only dealer we're now dealing with. That's 𝙎𝙬𝙊𝙎, my good friend Ian, who's on the program every couple of weeks with us to access deals. If you want access to his deals, click on access deals on the website, fill out this form. They will contact you. Ian usually does it in less than a day, as much as he can. And he's helping people out. Now, a lot of you will like him because he's offered 40% Kennedy halves for like $1.29, $1.39 over spot. 1,000-ounce bars, 99 cents over spot. He has some of the cheapest silver on the planet. He also does some gold. So he doesn't offer you everything and charge high premiums. He only offers what he can get low premiums on. I've had a ton of people go to Ian and get the best deals in silver and then call me up and say, Rob, thank you so much. So that's why we're settling on him. 𝙎𝙬𝙊𝙎 from here on forward. He's our trusted dealer. Ian, I talk with him every day. I just had about an hour conversation with him earlier today. High integrity guy, good guy, building a good business, and we appreciate him. Joel, thank you so much for the $5 contribution. I didn't see a question from you, but if you have one, throw it in there. Maybe we'll get to it next time. Thank you, everybody, for joining the program. This has been Gold. Why this time is different. We gave the presentation, similar one we gave this morning at Money, Metals, and Mines. I updated from what I did last year and gave you a lot of new information where we think that's going. I also talked to you about our new website, Financial IQ Television, all free financial expert advice, not mine, the experts. We bring them on the program. We talk about it. Real estate, gold, silver, stocks. Next week, we're going to bring you fintech. That's financial technology. That will include some conversation on crypto, financial apps, that kind of thing. We'll bring you personal finance here pretty shortly. We're going to bring you a bunch. We're going to try to be, like I said, the anti-CNBC. We bring you experts from across the financial spectrum so you can educate yourself on stuff, every type of investment, wealth management, tax structuring, things like that. We'll bring on tons of expert in the future, once a week podcast in each area. And we also put our gold, silver stuff on there as well. It's a one-stop shop. We're doing that to help you out because we're more than just gold, silver. And this is the best for you because I love you guys. You guys showed up big time at the conference this morning. I appreciate it. And as I have always said, you're the absolute best audience anywhere in YouTube land, anywhere, period, because you guys are serious. You know your stuff. You don't screw around. And that fits into exactly what I want. High integrity people who support the show and support each other. So that's going to conclude it for this Tuesday, April 5th, 2022. This is your host, Rob Kientz, Gold, Silver Pros, and Financial IQ Television now. This has been the Cowboy Metals Livestream. We broadcast from the great state of Texas, and we take no bullshit. And I guarantee you we'll bring you the best information that we can on a daily basis. No lies, no BS, no crap. That's what we do here. Thank you, everybody, for joining the program. Have a good night, everyone. Kiss your kids. Hug your spouses and have a great one. We'll see you next time.